All right, the recording is live. We're back here with another Monday one-on-one with our good friend Zach Cicero. We had a little bit of a schedule obstacle the last couple of weeks, so but we're good. We're all back. How's it going? How's your trading been treating you?
Good so far. I mean,
Where's my
just got the
Where's my 10?
got those. Well, I don't know where we left off last, but I don't think I did a whole lot just because of work
Okay.
and moving. But
Yeah, we both
we
got
can go off
super
of
busy.
we can go off of what I think I was able to get
Okay.
since.
All right, sounds good.
Let's see. I don't want to repeat, so we'll just start with the last one that I did,
All right.
which is DHC.
Oh, okay. We like that one.
Let me see if I can pull that. Oh, I still have it pulled up. You can tell I've been doing a whole lot on here.
Yeah, I hear you. Yeah, it's been a crazy couple of weeks, man. I was living in a hotel for a couple of days. Like I had to travel a bunch. I went down to Chicago, Indiana to work with Austin on some stuff in person, and then we went to I got my floors done at the house, so I had to go stay in a hotel there. Yeah,
It's been
it was all just back to back, and I was like, okay. But we're back. So I see this beautiful one right here, just obviously with confirmation bias, but just because I happen to be scrolling past it. But this is the kind of stuff that we like, right? Like these huge pops to the upside. So I like this stock. Like it has a history of respecting this strategy, right?
So mine was on May 2nd.
Of 2024?
Yep.
Ooh. Not quite the one I was looking at. Let's take a look. All right, you said May 2nd?
Yeah.
All right. On the daily time frame with the 20 MA?
Let's see. I had daily. Yep.
I don't currently
Let's
see
see.
one.
Where's mine?
Was that just
Sorry,
when you went?
not 24. I lied.
Oh, okay, no worries. I was like, that's a little.
I wrote down
confusing.
24, but I meant 18.
Oh, 2018. All right. Well, there's a slight offset
A
there.
little further back.
All right. We can time travel a bit. Let me just erase all these two so we don't get confused. All right. So you said May 2nd, 2018.
Yep.
Beautiful. Like that. Oh, that's nice. All right. And so when you went back in time, this is just the first instance that you found?
Yeah, I'm not sure exactly where I ended up going back in time to, but I was clicking away and then I found the little dude.
All right, I like it. So what I'm going to do is I'm just going to move that vertical line to the left just to show, because it'll cover up the wicks and stuff. So I'll just show that this is where we kind of started. So let me just go ahead and plot these lines out really fast. And, if you want to use the spreadsheet to cheat, you can, but I'll tell anyone. Then I'm just going to draw a long position here just so we can kind of get a rough estimate of what the trade would look like. And there's our 1 to 2 roughly right there. And then, so I kind of want to walk through it really fast just to see what I would have gotten. And then you tell me how close I was.
All right.
Sound good? We're switching roles a little bit. All right. So we'll just go through it one candle at a time. So there's your entry candle. You got your stop loss. You got your risk range. You double that for your take profit. All right. Let me just actually draw that line as well. And I'm drawing these crudely, so don't hold me too accurate. All right. Price goes up, price goes up, price goes up. And it may or may not have hit the target, but it definitely did there, right? So we lock 75%. Okay.
Yeah.
Now at this point we have a 5 candle run. So I would have locked some right here at the bottom of this candle. Is that what you did so far?
Let's see. So I had. One second. Let me find my original.
Okay.
My original square. It looks like I had my close for the 75% at 12.98.
Oh, okay. Was that for the 5 candle rule, or was that for your actual target, your initial
That's
target?
for first target.
Okay, cool. So it would have been inside that
Does
box.
that look right?
Yeah, I'd have to go like up a cent here, down a cent there, and then expand that. So yeah, you're in the rough range.
Pretty much,
I trust your numbers are more accurate than mine because I just kind of slapped them on here. All right, so then we get we breached the low of the 5 candle series regardless of the target. So now we're looking for potentially higher validated low, right?
Yep.
So candle, candle, candle. We get our higher validated low right here. So we take this stop loss, full stop loss, and we move this fella up to, yeah. Oh no, I'm sorry, it can't be that one. This one, this is the one I meant. That guy, right? This white candle? Because this can't be...
Yeah, I don't think I got that, but...
which part?
I don't think I did the higher validated low.
Oh, okay. Well, no worries. So in this case, this guy can't be the higher validated low because we get one candle, and then this one here is lower, so this becomes the new candidate. So in this case, we got our higher validated low right there. We get a series of 1, 2, 3, 4, 5, 6. So we got more than 5 here. Jeez. All right.
I think it went up. I have it went up 8.
Yeah, it went up to $14.04. And then it went up to $14.27, but we broke the impulse, right? The impulse reverse, so we locked that profit right there at the top. And then we get a higher validated low right after that. So let's go ahead and move the stop loss up again. And then we've got 1, 2, 3, 4, 5, and then we break here. So, and then we hit our stop loss. So we had another another 5 candle run that broke, and then that came down and hit the stop loss. Is that roughly what you had there?
Yep, I had the 8 candle, the higher validated low, and 5 candle, and then I ran out of shares.
Beautiful. All right, so this this entire trade occurred within these 2 vertical lines. Make sense?
Yep.
So you got a higher high, higher low, higher high, higher low, and then you broke the low, right? Pretty straightforward. Yeah. But each candle had a specific purpose in that, so it kind of helps us be a little bit less guessy about stuff, which is awesome. All right, cool. And then of course you got more opportunities, and uptrends are just nice when they're going up. That's beautiful.
Could have entered back in all the way till that big red drop.
Yeah, exactly. And at that point, it doesn't matter because you lock in, let's say you lock in this much profit exposure. Let's say just that even. And then let's say you grabbed this guy right here, right? Because that still counts. Maybe you take a loss like that. Maybe you take another loss like this. Maybe you take a loss on this guy. And then you enter on this guy. But it goes up, right? So maybe you get a profit, maybe you don't. And then, you got another opportunity right here. And that goes up, and you can use the 1% rule and stuff like that, so the risk range isn't working against you. But even still, just comparing that to that, that to that, that to that. I mean, I'll take these all day long in comparison to the size of those profits. It gets stupid. And when stuff goes down really, really far like this, you're not in it. So the size of this doesn't matter. It just tells you not to trade. So,
yeah.
It's pretty easy. Because, looking at this, there's traders out there that are like, it's coming back. I know it's coming back. Just a little longer. Maybe I'll add some more right here on the way back up, and then it shoots back down, right? And then you see this kind of thing, and they're like, oh, it's coming back. Yay, I'm going to add my last buy, which is what we teach in a sense, but it's difficult to kind of master that. And if you don't reduce at break even, for example, and you do see that, then you're going to hurt yourself. And then, of course, here we are, right? That's not coming back, buddy. And then at that point, you're having that mirror discussion with yourself. And you're like, man, I really should have just sold at my stop loss. And then it starts going back up, and you're like, I should have held it, right? And then you just...
Yeah, then you sell at the bottom, and then it goes back up forever.
Yeah, you're in an emotional blender, and you don't know what to do. So you rely on this default set of behaviors that your amygdala is like, hey, man, let's just use impulse, right? Because that's what it wants to do. Let's just use violence and get it out of our face. And the time for that was up here. Before all this happened, right? Because this is just not fun for anyone. That's 86% sold off before I even scrolled farther, right? That's rough. So best way to, as Miyagi said, the best way to avoid a punch is no be there, right? But it's easy to say and hard to do for a lot of people. So this is why we practice. This is why we develop the skills first, and then we can lead in with real cash. And I know it's super boring and it's not profitable, and I know it's frustrating, and I get that, but I'd rather have you bored than broke and frustrated. So
that's fair.
All right.
I think I'd rather that too.
Yeah, most people would, but it's hard to get them to admit that to themselves. So why don't we look through one more, if you have one, and then we'll start talking about some of the other stuff, the portfolio management, and I want to try to get you set up with some passive growth stuff, because that way you're not necessarily just waiting. You did say you had some dividend positions. We'll get into that.
Yeah.
Take a look.
So next one's going to be DBI on July 29th, 2022.
Oh, wow. My mouse was right there. All right. So July
Let me
29th. And that was the entry on July 29th. Okay.
yes, somewhere around there.
All right. So I'm not going to look ahead. I'm just going to put this here, and I'm just going to draw my lines, and we'll just see what we get. So on the close of this red candle on July 28th, we establish our risk range, right? We say, okay, we got a positive slope on the moving average. This stock ideally has a history of using this strategy and respecting it on this time frame with this length moving average. If not, we either don't trade it or we can adjust one of those two things, right?
Yeah.
So I'll get to that here in a second. But historically, let's just assume that it does, okay? So the following day on the 29th, we take our entry once it breaks over the opening price. And at this point, we'd also have our target set. I'm just going to draw a line here. I'm just going to roughly estimate it there. We've got our risk range, so we know exactly where we're going to stop out if it goes against us. We know where we're going to take profit if it goes in our favor. And we'll be able to scale out. So at this point, we would have locked 75% or more, or some majority of our shares. I don't know. I can't draw a rectangle. I'm having a day. So that's the easiest part. At that point, it's a guaranteed net profit of at least 1.25% if we're locking 75%. And we don't have to do anything else. We can just let the chart tell us when to do stuff. So at this point, we've got 1, 2, 3, 4, 5 candles in a row with higher lows, 6 candles right here, 7 candles, and then we break it right here. So we can lock another 75% of our shares right there. Is that what you had so far?
Let's see, what was that price for the 7 candle?
1438 was where the price breached. So 1437, you would have had a partial stop loss.
I don't know if that was the same entry. Let's see.
Okay, I'm just going on the lows of the candles here. I'm just looking at these right here. So you've got 1, 2, 3, 4, 5, 6, 7 candles that are higher in lows, and then you've got a breach of that right there.
Yeah.
All right.
So that's not what I have, but that's where I would have put it. Yeah.
Okay. Maybe there's some weird chart business.
My chart's lost again.
Oh no. All right. We get the date and the ticker, and we have a system, so we should be able to replicate those results, right?
Yeah, I was gonna say.
All right. So
28th of July. Yeah.
Yeah. Are you looking at 2022?
I am. Yeah.
Okay. All right. So either way, right now, since we got a lower low on the candles, that tells us we should start looking for a lower low, a higher validated low candidate, right?
Yeah.
All right. So every single candle that forms, if it's got 2 to the left that are higher and 2 to the right that are higher, it's a candidate. Otherwise, we're just looking for iterations of the 5 candle series. So in this case, we got a higher candle. So we're back at candle 1, candle 2, candle 3, candle 4, candle 5. So we've got a 5 candle run right here. So as soon as that one closes, we can push this guy up. We get another candle, we can push that up. And then it breaches right there to the downside. So at 1725, we would have locked another partial portion of the shares, right? And now we're forming lower lows, which means we're looking for a higher validated low candidate. We don't get that. So 1 candle, 2 candle, 3 candle, and then we breach it. So this interrupts the process. So now we're starting to get mixed signals, which tells us it might be time for this to start to pull back. So at this point, we've got a lower low candidate so far. I'm sorry, higher validated low candidate so far. Then we get this guy, which breaks below it. So this becomes the candidate. Then we get this guy, which breaks below. So that's the candidate now. And then we get this guy, and then this guy. So you can see it's kind of just pulling back. All right, so right here, we have a higher validated low. It's the only one so far, right?
Because both candles on both sides are higher than that one.
Yep, at least 2 on each side. Yep.
Yeah.
So let's move that full stop loss up here and then see what we get. So at this point, we would have stopped out of the trade.
Which could be a benefit.
Yeah, absolutely. So I'll just mark that. So it's so the entire trade took place between these the two vertical lines. Sorry. So similar as before, right? It's an uptrend. It's not difficult to eyeball that. So yeah, let's see what we would have gotten. So price action hangs out below the moving average for a while. Negative slope on the moving average. Massive sell-off, right? So those stop losses are our best friends. And these, I had no visibility on these tickers. I didn't know what dates you were testing. I'm just walking through what you give me. Yeah. It's pretty nice. All right, so really quick, what I want to do is just kind of look at the history of this stock and see if it matches with the strategy, right? Because that's one of the first things we want to do. We want to say, does the current time frame that I'm looking at, does it have a lot of wicks? Does it have a lot of gaps? And is that kind of normal for that stock? Does it have a high beta, for example? If it has a high beta, which is just a volatility marker in relation to the overall market, that means the stock has a lot of volatility to it, so it's going to see a lot of wicks, right? But it should also see some trending directions. So maybe you don't like to trade those. Maybe if you get stopped out a bunch, it might be frustrating. So maybe you're looking for something a little more stable. If it's got a lot of gaps, like this one's got quite a few gaps, that just means that there's a lot of extended hours activity. So maybe that's something you want to avoid if you can't actively monitor them and, stop out of trades when it's appropriate. And then the last criteria here is just how many examples. If I just zoom out, right? Just zooming out. And I look at like maybe the last 3 times there was a positive slope on the moving average around the time that I'm testing, which is over here. So if I am looking at the stock here, right? Because remember, this is the day where I started looking at it in this case. Mm-hmm. So if I look at this guy right here, this guy right here, then just kind of coming over here, that's kind of choppy sideways action. This guy's nice and clean. Is there a history of this moving average respecting this this strategy on this time frame? And there really isn't a great one. It's there. Like this guy, for example, is pretty good, but it's choppy. I don't really like the price action on this one. So the first thing I can do is I can modify the time frame. Now I kind of told you not to do this because I just wanted to get consistent data and show you that it's doable on any time frame. But I think if I look at the weekly time frame, I think we get a little bit cleaner price action, right? There's no more gaps. It's nice and clean. And then what I'm also noticing here is that the price kind of gets bisected by the moving average quite a bit. Like it just doesn't really turn around at the price or at the moving average. So that tells me maybe the length of the moving average can be adjusted a little bit. Like we don't like this chop. It's ugly, right? So what I can do, just grabbing a random sample here, just click that, and then you can just hold your mouse up and down until the price is a little bit more respectful, until it learns how to act, So in this case, I'm just kind of looking around here, just kind of seeing what I can do to get this to kind of line up a little bit better. So let me just see, this looks a little bit more appropriate. Now that's a weekly time frame, so it's much higher, much slower, much bigger price range, and it's a 109 period moving average, for example. Now the bisecting is still there, but it's a lot less, and the problem here though is that the price stays away from this moving average for way too long. So this is bad, right? Because we can't really trade that unless we want to take high risk stuff. So that tells me maybe I went in the wrong direction. Okay. What I can do there is I can move this right back down and just maybe kind of land somewhere in the middle where it's a little bit more respectful. Maybe like something like this, maybe like a 74, maybe even a little lower. Let's see what else we got. Nah, I kind of like it where it was. Kind of like 71, 72. And I just want to see that this is going to actually respect the price action. Now, in this case, it's not, right? It's just chopping through here. You got turnarounds that are nowhere near the moving average. So in this case, I need to come down a little bit farther, right? Let's just go ahead and keep working it down. And this is where it gets a little bit subjective, right? But again, the specific length of the moving average doesn't mean shit. Like, there's no unicorn number. Like, don't get committed to that mindset because it'll just hurt you. What there is, however, is opportunities off of that moving average, whatever length it is, that will provide you with minimal risk, and that's what we're after, right? We're not here to play probability. We're here to play risk, manage that risk. So let's just leave it at 52 really quick and just kind of see if we can get some better results. And I'm just kind of basing that just for specifics here because I know my eyeballs aren't tracked. I'm just kind of seeing this stuff. Like, these are where I'm looking. And then you kind of got like a little area right there. And I'm sure if I look back, there's some other opportunities right there. Get a little bit of a test and hold there, and then it moves up. So this looks like a much more reasonable compromise. You can see here it acts as a resistance a little bit. You still get some chop here. Here it acts as a resistance. Here it acts as a major support level. And then it gets kind of messy over here, which just is the price action. But here, it acts as a support. So this looks a lot healthier, I think, than the 20 period moving average. So if I were to just add both of those on right now, just to show you, the yellow one is the one that we started with. Zoom out, and then I'll just kind of toggle that one on and off. So this is kind of where we started.
Mm-hmm.
That makes sense. It's ugly. And then this is kind of where we ended. So not perfect, right? Because this chart kind of sucks, but our ability to read it is much more consistent. So this is something we can use a little bit easier, right? A little more easily.
Yeah.
And then a lot of times what you can do is once you set that high time frame, you can just kick it down to a lower time frame. And chances are it'll probably respect it quite a bit on there as well. Now in this case it's not a good example, but you know, a lot of times it will. Or it'll mesh with one specific time frame. So if I kick this down maybe to the 4 hour, I got to turn extended hours off, sorry. 4 hour looks pretty clean for this. Still some chop to it. Not a huge fan, maybe the 2 hour. But really just kind of, you just got to spend some time. Like just look around, see what makes sense, what matches. And then if you just get a chart where it's difficult like this, like I just don't like this chart, maybe you just don't trade it. Oh, that's a little cleaner. Yeah, so in this case, you see how well this is respected right here? That's what I like. And then see if we get some other examples here. A lot of the respecting of this moving averages to the downside, so we don't really want that. Kind of looking through here. Yeah, that's a good set right there. So this is really the kind of thing that we're looking for, just patterns like that. Not even really.
Are you able to see me well still? My computer just lost connection.
Yeah, I still see you. Yep.
Okay. Yeah. To my phone, then I'll watch on my phone while my computer regains.
Okay. Beautiful. Yeah, so all right, so what we're doing here is we're really just boiling this down to 2 time frames and 1 indicator, right? So all we're doing is making our process a little bit more efficient. So when you find that magical pair of time frames, you can make a note of it. So for example, this one right here under DBI, I would say 52 period moving average. You probably can't see that because the text is super tiny. Now I would write down 1 hour and 1 week. And then I would save that note. And then when I add this to my watch list and come back to it, I know which 2 time frames I'm immediately going to look at for potential setups. I know I don't have to look at the 30-minute. I know I don't have to waste my time looking at the 4 hour. And that way it just makes everything a lot cleaner and a lot easier. And I can still look at the daily if I want to. But if I want a slower trade, I can go weekly. If I want a faster trade, I can go down to the 1 hour. And that's it. And then I can just kind of base my trading around my own schedule and not have to worry too much about it. Does that make sense?
Yeah.
Okay. And it's just kind of seems like common sense, right? You're just kind of fine-tuning things a little bit that allows you to read the chart a little more effectively so you can manage your risk. All right. So with that said, I would like to get over into the passive income stuff a little bit. Because you said you picked up some dividend stocks and you wanna get the ball rolling on that. I'm super excited.
Yeah. So, I mean, originally I had the $1,000 in my account.
Mm-hmm.
Messed around with some small trades, stuff like that. I'm at 1,050 now.
Wow. Okay. So you made a little profit there, a little 5% profit.
Yeah. I'm up currently with my my open P&L. I'm at $13 up.
Nice.
With
okay. So you're locked in
with the I can't even figure out how to look at it.
Good.
Yeah, within QQQ, VOO, and SPHD.
Beautiful. All right, and those are for anyone who's watching this. Those are dividend stocks. They're just long-term, stable growth ETFs. So let's go ahead and look at those. So what I'm going to do here is I'm going to pull up stockanalysis.com, and we're going to look up VOO just so everyone can kind of see. Are you able to see that by chance?
I cannot.
You cannot. Okay, so it looks like the Google is doing some funky stuff.
Come on, Google.
I know, right? I wonder how we're going to do this. All right, let me see if there's an easier. Bring this over here. Does that do it?
While you do that, I just figured out how to find my dividend records.
Oh, okay. The payments?
Yeah, there's nothing on there yet, but I figured out how to see it.
There you go. That's seeing is half the battle, right? All right, are you able to see that now?
Yes.
Okay, beautiful. Ooh, I figured it out.
All right.
me zoom in a little bit. So it's too big. Slow down there, Killer. All right. So this is stockanalysis.com. It's a free website. You can use it to look up any research stuff for stocks. Now, let me close out all these other tabs here. You guys care about that. So if I look at FinViz, for example, and I pull up VOO, right? It's a Vanguard S&P 500 ETF. It gives you some basic analysis on a basic chart, and then it kind of gives you some metrics, right? So we can see, for example, this is a Vanguard-sponsored ETF. It tracks the S&P. It's got an expense ratio of 0.3%. It's got some technicals down here. The SMA 20 is 2.5% up, 4.67 on the 50 MA, blah, 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 right? All the numbers we don't care about. Now, this renders differently than a stock like Microsoft, for example, because Microsoft is a company. It's equity shares. It's not an ETF. It's not a mutual fund. So if I pull up FinViz here and I just type in Microsoft, you'll see some different numbers, right? You'll see, if I can make that a little bigger, you'll see like a forward PE. You'll see the PC, the free cash flow, quick ratio, current ratio, all the stuff that's related to an actual company, institutional ownership, insider ownership, the short ratio, short float, all that good stuff, as well as some, you'll see the gross margin, operating margin. These aren't all accurate, by the way, so don't ever trust just FinViz, but it's a good starting place just for the sniff test, right? Does this kind of pass the test? Does it seem like a good idea? We'll get into what all these mean in a minute, but just see that this is different from this. And the reason, again, is just because it's an ETF. It's a different appearance, because they're structured differently. So a stock is just a piece of a company, like we talked about the first time we had the masterclass. Company wants to get listed, they just break off a piece of their worth and they offer it to the internet, basically. And then people can buy and sell that piece of the company, and then if you have enough of them, you can vote and things like that. ETFs don't operate that way. They're not run by an actual corporation the same way, so they don't have the same structure. So in this case, if you look at an ETF right here, you can see the holdings that are within it. So it's just a big fund. It's like a managed portfolio, sort of. It's not managed the same way as like a 401k or a hedge fund, but it's just it's a collection or a basket of stocks, if you will, and some bonds and things like that. So in this case, the VOO, the Vanguard ETF, 21.3% of this is in electronic tech. So like Apple, Microsoft, Nvidia, Amazon, Meta, all the ones that are the big swingers in that sector, right? So it's a weighted ETF. 19.2% of the holdings in this ETF are tech stocks. So they're services like Snowflake, and I don't know if Snowflake specifically is in there. But like Nvidia is a developer of chips, for example. Amazon is an e-commerce platform. So they're two very different companies. Microsoft is mostly services and things like that. Then you got health tech, retail trade, and some smaller ones in there. These are just the different weightings of the company. And obviously, if it was a one that was weighted heavily in the health services during like COVID, for example, that would have a drastic impact on the performance of that ETF. So this year's an election year, so a lot of finance ETFs are going to be affected. A lot of tech ETFs are going to be affected, not infected. I'm still thinking about COVID. If, for example, nuclear energy becomes super prominent, then energy minerals and like ones that are weighted towards mining and industrial stuff is going to be ramped up. So if we look at stockanalysis.com back here, you can also see that same thing. It just doesn't provide the pie chart. And then you can also look at dividends. Give me just 1 second. Oh, okay, back. Sorry about that. Can you hear me okay?
Yeah.
All right. Cat ran down in the basement. All right. So if you look at the dividends tab right here, you can see the different metrics for how they reward shareholders, because you want a company to be making money and then also being willing to pay people to buy their shares. So in this case, this is one of my favorites. I like Vanguard and SCHD personally. I like the Vanguard and Schwab ETFs, but it's kind of hard to get a wrong answer, right? It's just a matter of how efficient they are as far as growth goes. But if you look at this one here, you can see that it's a quarterly payout frequency. And what that means is basically the ETF is just a collection of all those stocks that it holds. they take a portion of those profits and they pay them back to shareholders like you and I. They pay out on a quarterly frequency, so 4 times a year. The total amount per share that they pay is $6.77. You divide that by 4, essentially, which results in a 1.26% dividend yield. So 1.26% of the share price is what we get paid per year. So it doesn't seem like a lot, but we can reinvest it, it can compound, and the share prices themselves outperform that. So it's a pretty minimal, safe dividend payment.
And that's why I chose this one, is because I knew it was a safer route.
Exactly.
It might be lower dividend, lower risk.
Absolutely. And if you look at this dividend growth, for example, that's 8.64%. That's insane for a dividend company this size, or ETF, sorry. And the reason for that is because if you look down here, the dividends go up over time. And that's really what you want. Like, you want that to outperform inflation by just a little bit if you're trying to be conservative about things. Because a lot of people are going to see this. They're going to say, oh, this costs $537.10, and I'm only getting $6.77 per share per year. That's garbage, right? But that's not all you're seeing, because the stock itself also went up over the course of the year, and they're willing to pay you on top of that. So when a company or an ETF or whatever entity it is pays a dividend, the share price is actually adjusted. So a piece of that share value is reduced, converted to cash payment. You get that separately. You got to pay taxes on that. But the share price itself is reduced. So if a company or an ETF can outperform that, like some of the yield max ETFs, for example, they pay a very aggressive dividend, right? But their share price, given that they're using synthetic covered calls, that's a specific type of strategy, they're not really able to outperform that. So their share price goes down overall in most cases. And that's okay, right? Because we know that we can use that to our advantage as long as we understand, how it works and how to offset that. So when it comes to just solid growth, if you've got 6 figures and you're just looking for something stable that's going to keep growing and growing and growing, and you can reinvest and compound, VOO is a very, very popular choice. There's a lot of the Vanguard ones which are. And this one specifically over the next couple of years, I don't know if you've been on Shai's streams, but he very enthusiastically talks about all the tech stuff, where AI is growing. It's going to boom over the next 5 years pretty easily. So it makes sense to have a tech-weighted ETF to park most of your cash in, just to let it sit there and grow and outperform inflation and stuff. So so this is kind of like buying someone else's portfolio that has experience in the market and knows how to do this professionally. So it's always a good idea to at least consider ETFs and mutual funds. The only downside for like mutual funds, for example, is a lot of times there's fees and things, and that just gets a little bit annoying. And then once you get the skill set, you could just manage your own portfolio, and then you don't have to pay someone else, except the IRS, right? So when we're looking at dividends, you can see this one is conservative as hell, right? It's super low payment, but it's super stable, and it's very growth oriented. Now, if we knock the V and the O off of this, we get to O, which is a much cheaper per share price, and also, it's a pretty conservative dividend yield. So you're only getting $3 a year per share, but it's a much closer ratio. And it's a lower dividend growth. And this one specifically is known as a dividend aristocrat, basically. So that just means like they haven't reduced their dividend in like 30 years or something like that. So they always prioritize paying that dividend out, even if it means shifting things around on the other side of the company, right? VOO is very similar, in that they prioritize their dividend, but they have to dig into their stuff sometimes because it's an ETF, right? So, not so much, because they're really strong financially, and they have been. And they also just get a lot of market support, given the fact that they've just been so consistent with their dividends. And, if you go back to 1980s, for example, this guy was just pumping out dividends and just more and more and more and more. So it's very attractive. Are you familiar with the Pygmalion effect? Okay. So it's also referred to as a self-fulfilling prophecy, like using the 20 MA, for example, or the 200 period MA, or the Fibonacci's, for example. The more popular something gets, the more reliable it becomes. And then the more reliable it becomes, the more people use it, and therefore it becomes popular, right? So it's just a big cycle of, this works. I'm going to use this because it works, right? And then, it's working because everyone's using it. So that's essentially what is happening with O and has been for the last couple decades, is people just know that it's a relative safe haven for parking your money for dividends, and it's an affordable area. You know, you don't have to pay $500 a share. So it's insane, right? These have grown 27 years. It's pretty stupid. And that puts them in kind of a unique position, because it's nice to just have something that stable for growth.
Yeah.
And the cool part here is this one also pays out monthly. So for every one quarterly payment, over here on VOO, which let me just duplicate this real quick, and then I'll just change that to, I'll just look up VOO, sorry. We're going to add the V and the O back in. So this is a quarterly payout, and it pays $6.77 per year, so you divide that number by 4. And then this one here is a monthly payout, so you divide this number by 12, and that's what you get per month. So it's proportional to a degree, right? So you're not going to make millions and millions of dollars just on these, but it's a good place to just park your cash and let it grow. But this is a monthly payment. So the other one that you have, what is it, SPHD, I believe?
Yes.
Okay.
And QQQ.
And Q, oh yeah, let's look at that one first, because everybody loves that one. So this is the Invesco triple Qs. Anybody who trades options should be familiar with this, especially if you trade the morning strategies. So this one is a quarterly payout. And let's just go ahead and look at the holdings on this one, and I'll pull it up over here as well. Just so you can kind of see the difference there. So again, this one, you got quite a bit of tech in there, right?
Yeah.
So I am a little bit jealous. Okay, because I think you're in the right position for the next couple of years, as long as you view it on that horizon. So if we look at QQQ, you can see Apple and NVIDIA are at the top of the list, and the Microsoft is right under them. So 3 beautiful tickers for long-term growth, especially in the AI space. Okay.
Yeah.
And then if you look at the dividends, this one, quarterly payout, you get $3.04. It's a $500 stock, basically, or an ETF. But it costs about $500 per share, and you get a $3 annual dividend, roughly. Right?
Definitely not a good one.
Well, it's
in that term.
It's about a third of the size, or maybe a little under half the size of the VOO. But again, look at how stable it is.
Yeah.
Right? And more importantly, look at this number and look at this number. So dividend growth of 40% is beautiful. That's much, much better. And then if you look at the payout ratio, 24.55%, that's pretty good too. So this one, quarterly payout, not that great. Size, not that great, but the consistency is insane. So again, I can't really go back too far on this one. But this thing likes to grow, right? It's a little bit variant as far
Except
as
for right there at the beginning of 2024.
Yeah, they had a little bit of a hiccup there. But this one, it's got a lot of potential, and if there's ever anything that we don't like, or maybe we have a better opportunity, we could just trade that one.
Yeah.
So it's pretty solid. This is a benchmark stock, benchmark ticker, I'm sorry, that everyone kind of uses to get a general sense of the market. So really what they're following is the big tech. So, but tech is leading the market right now. So this is reliable for now as a marker, but it won't be, maybe 10 years from now.
Yeah.
So just kind of keep that in mind. So those are both the quarterly ones. They're the bigger ones. They're more conservative. So then you had SPHD in there, which is, again, in the realm of the O, right? It's it's a much lower cost. And this one is a lot of communication, and it's a more diverse holding. You can see that the biggest one is 2.81%. So, this is pretty good. So this one focuses on high dividend, low volatility, which is pretty nice because you want it to pay you.
Definitely what caught my attention.
Yeah, you want it to pay you, but not shake up a lot, right? So it's probably a hedged ETF.
Yeah.
And then the dividend growth here being negative is a little sketchy, in my opinion. It's got a 3.47% dividend yield, which is okay. It's an annual dividend of $175, but paid monthly, so it's nice, consistent income. It's right there with O. It just has a lower dividend growth. So let's go ahead and just take a look at that chart at the bottom so that we can kind of see. So overall, it's kind of going up. So it's good for just cheap shares to maybe round out a portfolio. But you can see that the dividend growth kind of struggles quite a bit here. So it's currently down many, many, many months in a row. So maybe that's something we need to be aware of, just because this typically indicates that a company might have to affect their dividend at some point. Or an ETF, sorry. So it's worth paying attention to, but just keep in mind that maybe they're a little too diverse and the overall market might just be kind of tugging them down a little bit. But it's still good, right? Because with dividends, it's kind of a win-win, right? You're getting dividend payments, so you got to pay cash, you got to pay taxes on the cash. But these smaller ones that don't really perform as well, like if you get a high yield, yield max ETF, high risk, high yield, you can sell those off. They're essentially armor plating. They kind of operate. Are you familiar with how armor plating on tanks work?
Yeah.
The blast plates. So you hit it with high ballistic, and then boom, it blows up. It offsets the concussive blast from the incoming missile, and it protects the tank. But it's gone, right? It just goes away.
Yeah.
So these guys that you're a little less confident in kind of act the same way. So rather than selling off your VOO and your QQQ that you're trying to hold on to and develop long term, you can sell these guys instead if you need to. So that way you get the capital loss to offset your tax burden. It's nice, right? Anytime we get to just screw over the IRS, I'm down. So you still get to collect the cash payments on these, but you don't necessarily have to pay the taxes so much in certain cases because you can offset that. So that's kind of the main advantage to these cheaper ones. And anytime you see high dividend, you just got to be a little bit careful. That's all.
Yeah.
Just because you don't want to end up in a yield trap. So this is pretty good. So I personally like SCHD.
After seeing I might take a little bit of, because I have four.
I got
I
some
have 4
for
shares
you.
of
Yeah,
I have 4 shares on SPHD, so I might cut back on some of those and throw them into something else.
Okay. Yeah, I was gonna say. So this one here is Main, MAIN. That's another really popular one. It's got an annual dividend of $3.84, paid monthly, 7.5% dividend yield. Shareholder yield not so much. Dividend growth is stable for its price. Buyback yield's low.
What's shareholder yield?
That's just how you like the overall per share. How much a shareholder would have made over a year per share, basically percentage-wise.
Okay.
So it's not that great, but that's also factoring in like the actual market value of the shares.
Yeah.
So what you can see here is it's a little bit wonky, right? It's up and down, but overall it's up. So it is what it is, right? It's within a 5-cent range each time this jumps, so it's kind of skewed data. It's just a tight range. It's candle bars essentially, or barcoding. So then there's this one, which is one of my favorites. I like VOO and I like SCHD personally. I like the Schwabs and Vanguards. So in this case, if we look at the overview here, you can see it's just kind of gone up over time. It's just nice. The holdings, it's also diversified. It's a little bit weightier than your SPHD. But if we look at this one, you can see it's got a 3.41% dividend yield paid quarterly, so it's not a super fast one. Only a 98-cent per share annual dividend, but it's a $29 stock. So it's a little bit nicer, right? And then it's got an 11.94% dividend growth. So if we look at this one, you can see that the dividends are just going up overall. Growth is a little wonky, but it only really dipped below here back in 2023. So it's pretty solid as far as the growth. And then if we look at something like Tesla, for example, TSLY, that's a yield max. Dividend growth is just non-applicable. Payout ratio is not applicable. So this one has a dividend yield of 97.4%, which is insane. That means that essentially it's an $11 stock and you get paid $11 a year paid monthly. So you get 1/12 of this per month. Now that is not a sustainable price, right? And that's why they do splits and things.
So that confuses me.
Yeah. Well, it's a ETF focused high yield ETF. So basically they're just trading a synthetic covered call strategy and like all the profits almost are going to shareholders. Which obviously affects the share price, right? Because it gets pulled off of there, which means it drops drastically. And if the share price can't outperform that and climb back up, it ends up at a net deficit for that pay period. And then the next one rolls by, it reduces the price even further. Next one rolls by, blah, blah, blah. Price goes down super, super far. They have to do a split to get back to a reasonable price so that's so it's attractive, right? So now what we can do with stuff like this is we can offset that against stable positions, right? Because we want that aggressive payout that I love, but I don't want the liability of holding this forever, right? Because you're going to lose your money.
Yeah.
And then these are the first ones to sell at tax time when it's time to tax loss harvest at the end of the year to realize those share losses and offset your capital gains on the other dividend payments that you're receiving. Does that make sense?
Okay.
So it all just kind of balances out, but there's got to be a proportion there. Like if you're not loading up on VOO, for example, because you're on a smaller account, you shouldn't be loading up on these. You really just need enough to offset the profits on the other positions. So if you put most of your money in this and only a little bit in VOO because you can only afford one share, you're going to lose money overall. And that just makes sense. Right?
Okay, yeah.
Now, the good news is you're collecting this dividend per share, which is insanely high, and you're selling the shares at a loss, which is also nice. The cool part is you're only responsible for about 35 to 40% tax on the dividend payouts as a short-term capital gains. And again, this is not financial advice, blah, blah, blah. You got to talk to a tax person, generally speaking. But for your losses, when you realize the losses and sell them, as long as you don't rebuy them within 30 days and trigger a wash sale, you get to deduct 100% of those. So as far as tax advantages go, it's pretty cool because you're only paying tax on a little piece of it and you're offsetting 100% of what you claim as a loss. It's nice, right? Because that increases your refund, which means you can put more money in and then you can reinvest it, compound, up to a limit, right? You don't want to get too far in over your head and then, oh, I took $20,000 in losses this year, but you can only claim $3,000 or $6,000 based on your filing status. But
yeah,
you got a couple of years worth of tax refunds there, but you can only use up to a limit per year. So that's kind of the role of these. It's not to make $1 million and it's not to launder your money, essentially, because if you put it all into here and then you get it all back, what have you done? You've just affected your taxes, right? So you don't just want to put everything into Tesla or Coney or NVDY or any of the other yield max stuff, but it is good to have these. You're just buying insurance. It's like a little armor plate against your bigger shares that you want to hold. Like okay. IBM, for example, it's a solid dividend stock. It's not a great stock, but it's a really good dividend stock. So if we look at this one, those dividends just go up over years. Now their dividend growth is going down a little bit. Not drastically, but it's going down a little bit. And that's just because they need to step up their game and get back on the playing field with AI in the mix and all that good stuff. So, but we'll see. We'll see if they decide to affect their dividend first or if they make changes elsewhere in the company to keep that ratio and keep a nice stable dividend yield, given that that's one of their best qualities. Brown and Brown, for example. Let's see if I can... Brown and Brown. Bro. Now, this one's had a dividend growth of 31 years, so it's really solid as well, 13% with a 15% payout ratio. Now, it's a $105 stock, and it's got a 0.5% dividend yield, so it's not super aggressive. But it's in my top 12 because if you look at this thing, it's a beast when it comes to dividend growth. And I'm okay with that because if I got $8 million, I want something like this. I don't want something that's all over the place and janky,
That's fair, yeah.
So that's kind of the thing that we like to look for. And obviously this only happens after we look at their financials, right? They have to have strong financials. Because remember, we're looking for the trifecta. We're looking for a company that's making money, has a future, and is willing to reward shareholders. So the CEOs of that company need to be making money for themselves. They need to be willing to share it, and they need to be reinvesting it into things that make sense for the company as well. And what we don't want is for them to divert their R&D budget basically to keep shareholders happy for a little while longer, because then that's going to affect them anyway. So
yeah,
if they have to make that choice, the company's already not good, right? In theory, they should be affecting neither of those two, because they should just be taking sales from elsewhere, using that revenue and leaving the dividend alone and helping it grow, as well as improving their investment sides. So if we look at like Brown and Brown, for example, year-over-year revenue, it's beautiful. That's a nice, healthy uptrend. Gross profit, nice, healthy uptrend. Operating income, beautiful. We'll go through a lot of this stuff a little more in depth, EPS diluted. But if you're looking for like a really good template of what a stock should look like, bro, it's just nice. Dividends per share, nice steady growth. So as a shareholder, this looks really appealing to me. Now it's not the best yield, but it's stable. Their EBITDA year over year is insane. Like just boop, boop, boop. Like it's almost tripled. That's crazy. Now, if we look at their balance sheet really fast, I'm not going to go through all these super in depth here, but cash and cash equivalents. That's beautiful. It's over $1 billion. Cash and short-term investments over $1 billion. Total current assets, nice steady uptrend. So they're acquiring stuff, their holdings. Total assets, beautiful uptrend. Current liabilities, it's an uptrend, but it's proportional at like a 3-to-1 ratio, right? For current assets, you got a 1 to 2. So you've got 6 there, and then you've got 5.391 there. So it's about even. It's a little over 1. Remember we talked about the current ratio.
Yeah.
And then for total assets over total liabilities, you got about 6 billion more in assets than you do liabilities. So that's good. It's like a 1.5. So I'm okay with that. Net cash debt, net cash per share. So all the negative stuff you want to see negative, and then you can kind of see where they're putting their money, or their investments, I should say. And then you can look at cash flow and all that good stuff, which again, we'll get into all that. I don't want to just rush through this. But net income is up, operating cash flow is up. Like this is where investing cash flow is inconsistent, but it's where it should be. Financing cash flow, same thing. I'd like to see these every other year kind of up a little bit, but it's good. It shows that they're kind of ebbing and flowing with their investment versus harvest. Free cash flow is up. That's beautiful. I love seeing it. And then, yes, we look at the dividends as the last piece. We don't ever just want to start with a dividend and be like, oh, I like this one, because that's a trap. So that is the kind of thing that I want to start working into these so that you have a little bit more insight into the stuff that you're buying and selling. Now, also just keep in mind that if you look at a company and it's solid like this one, revenue, if you look at that and then you see the actual stock and maybe the stock itself, that's going up. But if it was going down, for example, despite the company's strong financials, that's worth watching. It's worth paying attention to. But maybe it's not worth committing money to just yet. Right? So little things like that are worth identifying, because a company can be really, really, really good and the market will just absolutely shit on it. It happens all the time. It happened with a lot of my investments. It just happens. It's just one of those things, right? And then what's important, though, is we just wait for the technical side of things to line up, and then we can place our buys, right? So if you wanted to trade just this, you can do that with the 20 MA strategy. Right? If you want to build it into a reversal, you can do that by spacing out your individual buys based on where it's at within the 20 MA, right? So you just, every entry becomes a buy of many buys, and then price goes down, blah, 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 it turns around, price goes back up, boom, there's another 20 MA entry. You place your second buy. So now your average is lower, right? Price goes down again, you wait for the price to turn around, boom, another 20 MA strategy. Once it's on its way back up, there's your third buy. Maybe you're planning 5 to 10 of these buys. Right? And then by the time it's, maybe you're looking at one of these situations where it's just an aggressive downtrend, and then maybe it's an aggressive downtrend here, and then, you got plenty of room here. And if you space those buys apart, you say, okay, that has to be at least 10% apart before I place my next buy, or before I even look at it. It's going to go up or down from there anyway. So at that point, it's just a logic puzzle. You're like, do I see a positive slope on the 20 period moving average? Do I see a tiny red candle? Is this even 10% away from where I placed my last buy? Because if not, why the hell am I even looking at it? Because I'm just putting more money in the same spot, So you can combine all this stuff. You can identify a thematic. So like AI being big for this year, I'm just going to piggyback off of Shy's stuff right now just because it's easy. AI is booming. Uranium and stuff should be booming within the next 5 years because of nuclear and stuff. That obviously depends on the election. So those two sectors are pretty important right now. Banking as well. Then I look at stuff within them, right? I say, okay, well, how are these sectors lining up? What's the ones that are going to be performing the best, or how can I justify investing in something, right? Do they have a good future? Yeah. Is there a demand, right? And a lot of these tech companies, they're buying up hardware just for data storage. Doesn't even matter if they're involved in AI or not. They're just gobbling it all up. It's like buying up houses in a crappy market, right? They know the neighborhood's going to develop. They're just buying up as much land as they can. They're going to sell it to the guys that are successful, the ones that are building the malls, the ones that are building the schools. and they're going to get a return on that. So those are the ones we just want to watch. We don't want to trade those. But the ones that are involved in the actual development of the tech, the edge stuff, those are the ones we want to invest in because those are going to grow the most aggressively. So then you look at the companies that are actually participating in that, like NVIDIA, for example. It's a huge competitor. How are their financials? What are they doing to get an edge over their competitors? And how can I participate? Is the price currently moving up? Does it make sense that it's moving up? How do I justify the specific levels at which I'm buying or where, I want to put my money in this stock versus that stock? Which one is financially stronger? And then you look at the financials and you can say, okay, well, that's something I can measure, right? I could say, okay, let's just look at the balance sheet here. So I could say, okay, this one's total current assets are 59. Total current liabilities are 13. So that's a roughly 1-to-4 ratio, right? Then I come over here and I look at Microsoft and I say, okay, what's going on with Microsoft? I just pull up Microsoft real fast. I could say I look at the financials here, I look at the balance sheet, and then I say, okay, well, they got 159,734 in comparison to 125. So this is a much closer number, right? So I could say, okay, maybe Microsoft isn't as strong as NVIDIA as far as their current ratios, right? So I could say, okay, well, they can absorb, they're growing quicker. They can absorb a lot more of a hit if it comes to that, right? Like say some weird regulation comes out. So I'm already placing NVIDIA higher than Microsoft, so I'll look at that one first when it comes time to look at charts. And then all I got to do is say, does one offer a dividend over the other? Like if it's a tie, and I'm just like, okay, well, I want to invest in one and I want to trade the other one, right? So I'd invest in the one that has a dividend and the growth potential, and I'd trade the other one, just getting in and out along the trends, because they're both high quality stocks at that point. If I know that the sector has a lot of potential and I know that these guys are the top competitors or they have some unique defining feature, they should have an edge. So both the stocks should go up. It's just a matter of how I want to trade them. And then once I figured that out, I look at these metrics and then I just prioritize whichever one I want to make the most money on. Does that make sense?
Yeah.
This is before I even look at a chart. And then I just look at the chart and say, okay, well, this is exactly where I'm going to get in. Once I know whether or not I'm going to build into it or if I'm just going to buy it and then exit if it drops or hold it if it goes up, Do I want to build in and scale out or do I just want to buy and sell, right?
Yeah.
So these are all kinds of just little stages that you go through when you research a company. So if I go like thefly.com, for example, and I just say, let me just pick one right here, MNRO, for example. Not familiar with it. Let's just look at it real quick. Oh, Monroe. Sorry, my bad. I am familiar with that one. I lied. I'm just going to pull it up over here as well. All right, so Monroe is consumer cyclical. Right, it's auto parts. They sell brakes and mufflers and stuff. So I'm just going to glance at this really quick. I don't like these numbers already. It's a deal breaker for me. These are pretty close, which is good. Institutional ownership is over 100%. Don't like that. Bunch of downgrades. Hell yeah. So I don't like this company. So it might be worth a short. Or maybe I could trade puts on it if it's got a healthy option chain. So this right here is telling me, as I'm looking through my decision tree, this bunch of forks of decisions that I make, what I'm not going to do, right? I like the chart right here. I like that it's giving me a 20 MA opportunity, but it's got a negative slope and it's actually not giving me a 20 MA strategy. It's giving me a trend line support. So I'm going to skip this one. I don't really like it. But, or I should say I wouldn't trade it to the upside. But what I want to do eventually is get you to the point where you can trade anything pretty much in any way that you want. We're going to get you there. So
I like that.
Yeah.
Sounds good.
Any market condition, it doesn't matter. So in this case, I already know Monroe's a piece of trash, right? So all I need to do is, it's got a negative slope. Well, it looks like it's got a positive slope right there, but it's got a support line that it can fail, right? It's got an overall downtrend coming into this, and that's telling me that there's a lot of strength to the downside, right? So really what's happening here is it's respecting this 50 MA, the downside. So I don't need to try to trade this to the upside if I know it's going down. I just need to not jump in until it's time for that to actually happen, right? So in this case, what I've got, is a stock that I don't like, but it's got a clean chart. It's got a downside chart. I need to look at the option chain, so I'd look at that in Webull. I can't pull that up easily, so I'm just going to leave it the way it is for right now. But I can look at the financials and say, okay, well, what kind of revenue are we dealing with? So let me look at the income statement. Is revenue declining? Kinda. It's pretty elevated, but it's declining recently. What about the gross profits? It's kind of declining. Operating income's declining. Net income declining. EPS basic. That dividends per share, that should be, oh, okay. So what this company is doing is they're rewarding their shareholders, but they're not really making money so far. Right? So that tells me they're trying to pander to shareholders to save them. So now we're going to look for supporting factors, right? We're going to play devil's advocate, and we're going to look into, oh, that's ugly. They got no cash. All right. Total current assets declined. What's their liabilities? Are their liabilities going up? Yeah, see? So they're taking on debt. That's not good.
Less assets, more liabilities.
Yep. So total assets is reducing. Total liabilities is flat. So it's not really increasing, but their current liabilities are. So I want to figure out where that's happening. Because from this period to this period, so, 2022 to 2023, sorry, they increased their current liabilities, so short-term scheduled debt, by almost 30%. Not good. So I want to know what happened there. So I'm going to go look through the 8Ks and figure out what happened during that year. I cared. Net cash. All right, that's not good. So let's look at their cash flow real fast, figure out kind of what's going on. Net income's declining. Operating cash flow is declining. Investing cash flow is wonky. Net cash flow, free cash flow should be declining currently, but a lot of justification here for a bearish trade, right? Now, does this guy offer a dividend? Yes. Okay, so quarterly payout, 4% yield, 102% payout ratio, 5.5% shareholder yield. So it looks like they're a little bit higher than they should be on their dividend payout, and it looks like they just keep trying to increase that. So I think this is kind of the lifeblood of them. But I will say that once it comes time to pay the bills, they're going to prioritize paying those bills over you getting your dividend.
Yeah.
So that tells me if I want to short this, that means that I do have an obligation. So if I'm borrowing shares, basically, I have an obligation to cover this dividend cost since I'm borrowing at that point. So that's just something to be aware of, but it's not that huge. That's okay. So in this case, I would look for a short opportunity on Monroe. Right. Now, whether or not we look at this 6 months from now and it's way, way up over $200, doesn't matter, because at that point, I wouldn't have got my short opportunity, right? But the justification for it going down is much more compelling than the justification for it going up. So if we look at the news here, for example, they just announced their dividend 2 months ago, according to this article here, and 5 weeks ago they did that. 2 months ago they did all that. So it looks like they're not very active in the news space, right? So, therefore, no news, no growth, right? So yeah, I kind of like this one for downside trades. I just don't like the stock. I hate it. It's stupid. It smells. Now, if we look at the yearly, which is the monthly, and then every 12 candles is a year, 2023 was a horrible year for them. They got a huge sell-off. They got a 25% pullback, and then usually when this happens and you get a new low, that's it. It's game over. You're gone just as much down from this side. So I would look for a negative opportunity here. So next step, rationally, now that we know kind of the bias and the justification for it, we got a whole thesis here. We can then start to look at things like the options data. Do they offer a lot of contracts? Is there a lot of volume on those? Can I trade them effectively? Or is it a waste of money to buy options contracts? Otherwise, am I on a margin account and can I short the hell out of this thing? If so, when can I do that and how fast can I do it, right? If I don't have a margin account and I can't sell options, I wouldn't be able to trade this as a long trader, right? So given that, I wouldn't have even looked that deep, but I can, so I'm going to. But this is a good opportunity to just say, I have every confidence in the world right now that Monroe should be going to the downside at some point relatively soon. As soon as they cancel that dividend, it's game over. They're going down to $5. Do I need it to go to $5 to make a profit? Yeah. All I need is an opportunity here to the downside. So if I'm looking at the 20 MA, all I need is that negative slope, a tiny green candle, and then a red candle to conquer that, and I got my trade. Just like it would to the upside, right? And I grabbed that randomly off of this thing. I mean, you could do that with any stock. Like you always start with a story or thematic. Then you start with the sector and how the sector's doing, how the stock places within that sector, like what makes the company special within the sector. Then you look at the company itself, the financials. and then that's going to tell you whether or not it offers a dividend, right? And then once it passes all that stuff, then you can look at the stock chart and say, okay, well, when should I place my buys and how do I want to buy this thing? You know, what's my approach here? You know, that's a lot like just being a pilot, right? If you're flying a huge, 737, you're not going to land at a small airport. You're going to crash and burn. So if it's a big stock, you know, you don't want to just do the wrong thing. You don't want to just commit because it can't handle you, you know? So it's always better to land a small airplane at a big airport. So you can always break up your buys and reduce that risk. So in that vein, you know, you can do this with every single one of these stocks. I don't care what it is. There's always a trade to be had, and there's always a way to do it. It's just a matter of whether or not it's worth it, and whether or not you can justify it.
Yeah.
So going forward, I kind of want to build you into those steps. So I kind of already have that going to the Rags to Riches team. I have them doing the sector comparison, the company breakdown, the financial breakdown, and then the technical analysis and the small team thing. But we're going to kind of focus on one at a time for you and kind of get you up to snuff on all four. So we've already done the technical analysis. I feel like at this point you're pretty confident in your ability to find them and mostly identify that risk, because that's really all that matters. We learned how to adjust the time frames, find time frame pairs, and adjust the length of the moving average if needed. So you can find even more opportunities, and if you like a chart, you like a company, now you can go out there and get the actual trades, even if it doesn't line up on the daily, right? So you've already increased your skill set. Then we're going to build into the fundamental stuff. So we're going to look at the company financials. We're going to look at the FinViz stuff, all these metrics down here. Like what's a price to book ratio, for example. We're going to learn the ones that matter and the ones that don't, and we're just going to throw away all the stuff that doesn't matter. A lot of it's redundant. Nobody tells you that, but it's all the same stuff. So, and everything that we're going to do is going to have that same goal. Is the company making money? Is the company willing to share it? And do they have a good plan to keep making more money? All right. So we'll dig into the fundamental stuff. Then we'll look into the actual companies. Like if we go to Monroe Muffler, right? We just go here. Actually, no. Let me just type investor relations. Sorry. Gonna go here. All right. I don't care about your cookies. I'm hungry, but I don't want them. I can go here. I can look for this. I don't care about your cookies. There's investor presentation August 2024. So I could just pull this up and I could just look at the company and see, like, what are they doing? What does the actual company do? What are they trying to do to grow? Do they have any plans to, merge with another company? Are they going to get sold? And you can just, one of the cool parts too is a lot of the companies like to brag about their metrics and stuff. You could just pull up last year's and see if that number is bigger or smaller. And just really spend some time kind of getting to know the company. So if you're viewing these as investments, you really want to just kind of dig in and get familiar with them. But there's a lot of information out there. It's just a matter of finding it without going through all the crazy mumbo jumbo.
Sorry, I got something going on right now. Sorry.
No, you're fine. I was actually just going to cut it off. Do you have any questions so far about the 20 MA strategy?
I don't think so, honestly. I think the strategy's doing pretty good. I'm excited to get going on this the dividend side of things.
Yeah. All right, cool. Well, we got you a base plate to start with, so don't I kind of threw a lot of information at you, so don't feel like you have to know it all. What I would like you to do is go pick a random company.
Yeah, okay.
And I want you to just spend some time looking at it. And then I want you to tell me about the company as far as whatever you can decipher from the financials and the dividends. All right, so that's your homework now. It's just, I'm not going to tell you.
Pick a random company.
Yep. I'm not going to tell you how to do it or what it all means. I just want you to go out and just look at the financials, get what you can out of it, right? You can cheat if you want, but don't cheat yourself. And then just tell me what you think about the company.
So try to find good and bad companies.
Yeah, just find a company and tell me how it is.
Sounds good.
Yeah, if you want to do multiple, that's awesome. We can do that. I just want you to get some exposure to the financial stuff.
Yeah.
And also give me at least, let's say, 3 20 MAs.
Okay.
Just so we keep that skill set up. All right.
And 3 20 MAs.
Yeah.
Boom. Got it. Written
Beautiful.
down.
All right, man. All right, so next Monday we'll do the same time, same bat channel, and then you'll come back with a some financial insight and 3 20 MA setups, and then we will be ready to move on to the next part.
Works for me.
Beautiful. And then the 20 MA stuff should be so small and insignificant at this point. It should be so easy and second nature.
Simple. Yeah.
Right? Isn't it a lot easier than when you first learned it?
It is.
It's stupid.
I still am not comfortable enough to do it with real money. However, that's fine. Yeah.
That's perfectly
I got my
fine.
dividend stuff making money for me. I don't need that part yet.
Absolutely. Dude, it takes so much of the pressure off. If you just make consistent contributions and you put the bulk of that stuff into passive income that you know is financially strong and will grow and reward you, you can completely destroy the other 30% and still grow a portfolio. That's why I did the rags to riches. Like 90% of those guys grew a portfolio, and the 10 that didn't were just people that stopped participating. Like I just didn't count them because they just stopped like reporting their stuff. And I was like, okay.
Yeah.
But the 90%, like the people that did, all had a green trajectory on their portfolio, and it didn't take a whole lot of effort. It was just because they stopped losing most of their money that they were putting in. So we can do that here. It's easy. So let's start with that. I'll catch up with you next Monday, and then we'll recap and we'll get digging into the next part of it.
Works for me.
All right, man. Thank you very much. I'm going to stop the recording right here.